Hi, and welcome to Hedge Fund Manager. I'm Karl-Mikael Syding, and today we're doing this deep dive into LVMH, and we've come to making a bit more nuanced work on growth rates and margins. The aim here is to come up with a best estimate of earnings per share in, let's say, 2 to 4 years' time. The reason we want this is that we have to have a starting point for what we consider being the steady state for the company. And from the steady state, we know what multiples are warranted using, for example, MoneyChimp or our own DCF calculation. And so we already know what we think will be a normalized, warranted price earnings or price sales or price book multiple in, let's say, 2 to 3 or 4 years. But what we need is a nuanced forecast of what that platform, the normalized earnings per share or normalized sales, normalized margins and normalized growth rate going forward from there. So from today's situation, which always have a lot of one-off factors and very and particulars, we want to model a likely starting point in a couple of years' time that will be our normalized proxy for this company, which is the base for a normalized valuation proxy. So that is what we're going for, finding a platform of normalized levels for the company. But in order to get there, we must make more detailed and nuanced research on where the company is right now. So, for example, we can pull up LVMH's numbers either in their own annual reports, or we can actually use a free online resource like Koifin as our starting point. So here we can see, I pulled up the quarterly numbers here, and we can see that they have had growth rates. So these are year-on-year growth rates. So it's the fourth quarter compared to the fourth quarter the year before, for example, or the third quarter compared to the third quarter the year before. And here we can see that the growth rates have been, it's come down from 15% yearly rate to 3%. Well, actually, they are just only reporting half-year numbers here, and that's why the quarters 2 in a row always look the same. And we can see they've been at -1%, -2%. And the last few half-year earnings reports. So we're definitely not seeing the 12 to 15% annual growth rates lately. And we can pull up LVMH quarterly numbers here and take a look at the year-on-year growth rate on a quarterly basis, and you can see here how it's come down from huge numbers, and it's actually those comparisons that have created a bit of a headwind. And then recently we also have the fundamental headwind in terms of a global slowdown, and now on top of it all the tariffs that will put a dampener on global retail sales. So using these numbers and taking into account that the world is slowing down and that tariffs will come on top of this, and just seeing that the actual numbers the last few quarters have been pretty stable here around well, more or less flat to negative year-on-year growth rates, down from a previous steady level of maybe 12 to 14%. So we can also now access the actual LVMH numbers, and they just now reported Q1 numbers. and we can see that their total sales came down by in 2025 down to -2% in reported sales and -3% in terms of organic sales. So the difference here is currency rates. They are actually here not really giving any detailed guidance. They say they will rely on all their typical strengths in order to strengthen their global leadership position, but they're not really saying that they will come back to any strong growth, rather that they will have headwinds here for some while. And so we take into their guidance into account. We take the historical sales growth recently into account. And I would say that a fair estimate for 2025 and 2026, all else equal, is that they will probably not grow in 2025. Rather, they will probably lose maybe 5% per year, rather, because the rest of the year is likely to be even weaker than the first quarter. I would also worry that their margins, let's take a look at their net income margin here, and we can see that it has come down by quite a bit in the last year. But before that, they had a really positive trend in terms of margins, and that is what to be expected from a global leader that is becoming bigger and bigger and adding scale and efficiencies. So I would say that this 12% net margin is a bit on the lower side once we get to normalized level. But I would also suspect that it will actually go down by a bit more during 2025 as revenues actually decrease, and they don't have really that many levers to pull in order to increase profitability with decreasing revenues. So what we do here is we can see what the most recent margins have been, add on top of that a little bit more headwind, and therefore estimating even slightly falling profit margins. Although I would say that this is just for 2025 and 2026. After that, I would expect them to have adapted to the new global order, and from there, it's very likely that they have strengthened their position and that they now have local production. They can circumvent tariffs, and maybe even a lot of these tariffs will have disappeared by then, or never actually really been enacted for the very long term. And that means that from there, up until a point, maybe 3 or 4 years into the future from now, we will see a stronger LVMH with higher margins, definitely higher than these 12% net margins. I would rather think that they would be at 13 or 14% margins, which is where they were heading earlier here. And they should be the ones benefiting relatively more than other luxury goods companies in this harsh environment, thanks to their scale and their global operations and their very, very strong brands. So these are what we take into account when making our estimates for the coming few years, and then through this U shape in terms of margins and sales. After that, in 2027 and 2028, we should expect a return to what should be their normal growth rate again of let's say 10 to 15% in sales, and slightly more in terms of profits. And then we end up at in 2020, let's say 2028, with their normalized earnings per share and a normalized sales level and margin level, and it's from there we will apply the warranted PE multiple of somewhere closer to 25 or 30